the long side has a little bit of logic to it. I mean, it's like if something is cheap, you're more inclined to own it than not own it, especially if it's something that's been around for 5,000 years. It's something that has spiked up in price before. There's a good reason to own it. What is the good reason to be short so much silver? These guys are short 500 million ounces. 7 traders are short close to 500 million, 500 million ounces of silver. And what for? Where's the sense in being short such a massive amount of silver, okay, or any commodity that is cheap? I say the only reason, it's not a legitimate reason, but it's a reason, is that if it weren't for these short sellers and this huge short position, concentrated short position that they put on, silver would never be this cheap in the first place. And now they're in a bind, okay, because having created such a large short position and a relative cheap price, okay, how do you get out of it? How do you fix this? How do you say, I don't want to be short anymore? Okay, it doesn't make any sense. And the only way you can do that is to buy back your contract. But the problem is, if these big shorts go to buy back their contracts, and they haven't made a real move yet, maybe a little move, but a real move to buy back yet, there'll be no real sellers, since they were the sellers of last resort previously. So you're in a bind here. How the heck can these guys get out of their short position by buying them back without sending the price sharply higher?
As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Welcome back to Finance and Liberty and Reluctant Preppers. We have a returning guest who is always highly anticipated by our viewers. This is Ted Butler, founder of ButlerResearch.com. He's widely followed as a silver market analyst. He's here with us again this Sunday, January 26th, 2020. Ted, thanks for joining us again.
Thank you, Dunnigan. Good to be here.
Hey, the last time we had you on in December, we were talking about what we expected in terms of silver price action and market dynamics going into the end of year, which is traditionally a strong period. And you gave us your insight at that time, as well as some unusual, actually unprecedented behavior you were seeing of major players on the major physical markets. Can you talk to us about what has played out going through the end of the year and now in the beginning of 2020, and whether you see those dynamics still in play and what your view of the road ahead is?
Okay, there's a lot there. Last first, this thing that we discussed back in mid-December is still very much in play. In fact, I think it's the key factor, head and shoulders above any other factor as far as having a price influence. Basically, in review, what we talked about then was this unusual mismatch between the speculators, managed money traders, technical funds who were massively long in both gold, COMEX gold, and silver futures. And on the other side was basically a handful of very large speculators that are camouflaged and included in the commercial category, banks mostly that are short and near and at record short levels. So there is a tremendous disparity between the longs and the shorts, and the longs have always capitulated in the end over the last 3 decades. Anytime they get massively long, the shorts on the other side, the banks, are able to somehow rig prices lower, pull the rug out from under these longs, and the longs just and we end up in a cascade of selling by the speculators who are long, and all the shorts, the big commercials, buy back their short positions at a profit or at no loss, and that's been the wash, rinse, repeat cycle that has gone on in COMEX, gold and silver, and other markets for literally for decades. This time, it has been looking different in that given some price weakness that we had in the fourth quarter up until our last interview, and where we fell below key moving averages, 50-day moving averages in gold and silver. Something unusual happened. The long speculators didn't sell, and by them not selling, the big shorts were not able to get out of their short positions, and so it presented an unprecedented situation. That unprecedented situation has become more extreme. After our interview, we did rally into the year end, I think, as you suggested or asked if that was possible, and we ended up in December. It's been mostly a gold rally up until now. Silver's kind of tagged along, but it's not that far behind. In any event, the rally in gold and silver prices into December 31st created the largest mark-to-market. Everybody has to set their books for tax reasons on December 31st, and these are open derivatives contracts, these futures, and the run-up in prices into December 31st, principally in gold, caused the 7 biggest shorts in COMEX gold and silver futures, all banks or financial firms in the commercial category, to have to report and book the largest open loss in history as far as end of quarter, end of year. The number was like $3.8 billion. Subsequently, since the first of the year, the rally has continued, and as of Friday, this past Friday, 2 days ago, the loss has widened by another $1.4 billion to now it's up to $5.2 billion for these 7 big commercial banks. That comes out to like $750 million per trader on average. I'm sure there's some that have $1 billion or more in loss, and some that have less than that. But it's come at a time where I don't know how these big shorts extricate themselves, get themselves out of harm's way, because these guys have never lost. They've never been forced in history to buy back short positions, to the upside and at a realized loss. They've never done it. That's the heart of the silver and gold manipulation. These big commercials just sell and sell and add more shorts until the other side caves in. The other side, the longs, aren't caving in, and while no one knows what's going to transpire in the future, particularly the near future, these big shorts look to be potentially in very serious trouble. And I can just say, if, and that's a big if, they do decide to bite the bullet and get out of these dangerous short positions, which are costing them many hundreds of millions and even billions of dollars, and decide to go into the market, the only way you can close out a short position is to buy it back. And if they come in to buy it back, then watch out, because prices will explode much faster and further, both in gold and silver, than anybody expects. This is not something that has ever happened before. I can't say it's going to happen, but boy, it looks like it's set up to happen. And we'll all get to see what happens in the near future.
In the past, you've also described to us your research about a potential correlating factor, and that is J.P. Morgan having amassed a massive, perhaps record hoard of physical silver prior to this. And you even made the comment before that never before has J.P. Morgan been so well positioned on the long side. Is that still what you're seeing in your? Does your research still bear that out?
Oh, absolutely. I didn't mean to leave that out, but the way the government, the CFTC, composes and comprises their concentration data, their commitment to traders report, is they list the 8 largest traders who are short. Well, if you noticed, I said the 7 big shorts. The reason is that J.P. Morgan, which is still a member of, not the largest short any longer, but it is still a member of the 8 largest traders who are short gold and silver, but not number 1. I remove them, okay, for the reason that you just mentioned, which is that they have this massive physical position. I say at least 900 million ounces of silver and 25 million ounces of gold that they've accumulated over the last 8 or 9 years. So that takes them out of harm's way on the minor short positions that they have on the COMEX, and absolutely, it's the key. I mean, that's why if J.P. Morgan, okay, doesn't come to these other 7, 8, 9 big shorts rescue and begin to J.P. Morgan itself begin to add aggressively new short positions or donate, basically give away any of their physical position, that's probably the only way I can see these big 7 big shorts of getting out of the market. So, yes, J.P. Morgan is an integral part of this whole thing. I think they've lined themselves up to really double cross these other big commercial shorts. And just to give you an example about how good, in almost criminal terms, J.P. Morgan is, the 25 million ounces of gold that I've said for years that they own, their average price on that gold is about $1,200 an ounce. Okay, they bought it back over, principally in the big price collapse. They got about half of it in the big price collapse in 2013, when gold prices really cracked to the downside. They picked it up on the downside. They're good buyers. The 25 million ounces that they hold at an average price of $1,200, if they're ahead as of Friday's close, something like $370 per ounce. It gives them an open profit, J.P. Morgan, on their physical gold position of over $9 billion. This thing may just be getting warmed up, and already J.P. Morgan is ahead by over $9 billion on their physical gold position, and they're even. Their average price on silver is 18, so they're even there. I can't see anything bad ever happening to J.P. Morgan. Not that it shouldn't, but I can't see anything happening to them as a result of any short squeeze on the COMEX for these other 7 big shorts. They're going to make more money. J.P. Morgan is going to make more money than anybody if gold and silver prices move sharply higher from here. And they've already made probably more than anybody so far in gold, and nobody knows about it. It's kind of crazy.
We have a question here from AUAG Goldbug, who says, why is J.P. Morgan allowed to continue to manipulate metal markets when their traders were just indicted under RICO charges?
Boy, that's a good question. Well, none of us. I mean, this is stuff that's going on at the highest levels. You can't get any higher than J.P. Morgan and the various U.S. government federal agencies, including the CFTC, including the Department of Justice. Look, it's a question far above my pay grade. All I look at is public data, reports that are put out by the government, and the flows of physical metal over the last 8 or 9 years to tell you what J.P. Morgan is up to and what's going on the COMEX, as to why the Department of Justice or the CFTC keeps their hands off, or J.P. Morgan gets constant get out of jail cards free. I mean, that's not my. If I were the prosecutor, I would answer differently, but I'm not. I'm an analyst, and so it's a good question, but I don't have the answer.
All right. There's a perhaps related question here by Ian Cassie, who says, does Ted think that there may be a tie between the over $19 silver spike that we saw in September and the Fed bond repo blowout where interest rates spiked in September? Or was the price increase insignificant in the overall repo market just a coincidence?
Well, that's also an excellent question. I think it's a little bit out of time sequence. The run up to got up to like 1960 or something like that in silver occurred in early September, like at the very end of August, September the 3rd, something like that. That proved to be the high, and prices came down subsequently. The whole repo thing, which I'm not an expert on, but just in order to answer the question, the whole repo thing exploded, I believe, on September 16th, 17th, that days. What I found interesting was not so much the price action, because the price had started to come down since that earlier spike in the very beginning of September, was that the repo crisis exploded on September 16th, 17th, which is exactly the same day that the Justice Department charged the 3 traders at J.P. Morgan with running basically a criminal enterprise. I've speculated, and that's all it is speculation, that the timing is just uncanny. To the day the repo crisis exploded, on the exact same day that that J.P. Morgan's traders were charged, and I've speculated that there is a connection, but the connection is that J.P. Morgan did not like whatsoever the indictments, okay, and basically lashed out back at the Justice Department and the U.S. government, and intentionally created this whole repo crisis, because if you study the details at the time, everybody laid the finger on J.P. Morgan for adjusting its balance sheet, which is what caused the repo thing to get taken off. I mean, I think it's a battle. It goes back to the first question that the reader just asked, which was basically, why doesn't the government crack down on J.P. Morgan? Maybe the question is that the answer is that J.P. Morgan has such power that it can turn around and crack down on the U.S. government, and it's not something we'll ever know for sure, I don't think, but connecting the dots, the visible dots that we can see, the fact that both the repo crisis and the indictment for J.P. Morgan took place on the same day is like, hey, is there a connection here? I think there might be, but it's certainly in the realm of speculation.
The correlation there, I guess, is, it's not only the date itself, but also the player, one of the major players involved in that, or the major players. Okay. We have another question related to this from Pina Posco, who asks, when the banksters build massive short positions at the COMEX, doesn't it also mean that there are equal contracts that are long, as futures need to have two parties, one long and one short? Please clarify.
Absolutely. This is, commodity futures, derivatives trading 101 that you would learn in, if there was a commodity school, you'd learn it in kindergarten. And it has to be. It's a derivatives contract. The contract is between two parties, a long and a short. So, yes, in every derivatives contract, including COMEX futures on gold and silver, there has to be a long for every short. So that's correct. Now, this is the problem right now. The real problem is that this business of there being a long for every short implies that there's like an equal number of longs versus an equal number of shorts, and that's not the case at all. There's the matter, and the most important matter is concentration. The problem on the short side, of COMEX, gold and silver futures, is that basically the entire short side, the complete total short side of both gold and silver is essentially, held by very few traders. The 7 or 8 big shorts basically control the entire net short position on the COMEX, whereas while there is concentration on the long side as well, it's nowhere near as large as the concentration on the short side, and meaning that the long side is much more diverse. This is what it comes down to, You got to use a little bit of common sense here, is that if you look at something like silver, which is cheap by any relative, historical, absolute basis, it's probably the cheapest precious metal out there. It's the cheapest it's been relative to gold. That's what we use the gold-silver ratio or the silver-gold ratio to measure. You'd say it's cheap, You'd have to say it's cheap. Whether it goes up or not is something else, but it's not expensive. Therefore, it would be logical for somebody to buy. You buy cheap things. You don't sell short, cheap things, because there's not much in it. The fact that the long side has a little bit of logic to it. I mean, it's like if something is cheap, you're more inclined to own it than not own it, especially if it's something that's been around for 5,000 years. It's something that has spiked up in price before. There's a good reason to own it. What is the good reason to be short so much silver? These guys are short 500 million ounces. 7 traders are short close to 500 million, 500 million ounces of silver. And what for? Where's the sense in being short such a massive amount of silver, or any commodity that is cheap? I say the only reason, it's not a legitimate reason, but it's a reason, is that if it weren't for these short sellers and this huge short position, concentrated short position that they put on, silver would never be this cheap in the first place. And now they're in a bind, because having created such a large short position and a relative cheap price, how do you get out of it? How do you fix this? How do you say, I don't want to be short anymore? It doesn't make any sense. And the only way you can do that is to buy back your contract. But the problem is, if these big shorts go to buy back their contracts, and they haven't made a real move yet, maybe a little move, but a real move to buy back yet, there'll be no real sellers, since they were the sellers of last resort previously. So you're in a bind here. How the heck can these guys get out of their short position by buying them back without sending the price sharply higher and therefore damaging their existing positions that they're short? I started out the conversation by saying how much money, how many billions of dollars they're already in the hole, because they're short positions have gone up since when they sold them short. And it's like, how does this end? This is insanity. This is madness. Why is the government allowing it to take place is a darn good question, to which I don't have a good answer, except what can they do? And they should have done something a long time ago. It's the key issue. This is at the heart of it. Yeah, there's a long for every short, but the shorts are like so few in number and so large in position and have no justification. They don't have the metal. Okay, they're not hedging in any other market. Somebody is long and somebody is short. These are the guys that are short, these 7 banks or financial institutions, and they shouldn't be, and I don't think they want to be anymore. But the problem is they're already committed. It's called a futures contract for a reason. It's a contract. They've contracted to either buy back their position or to deliver physical silver. How the heck they're going to do that, okay, without sending prices to the moon, I don't know.
Interesting. Related to that is this question that comes up every time, and that is from Joe Maxwell says, how long can the JPM-led cabal continue to dominate the PM prices with their naked shorts? At what point does the actual physical market overwhelm the manipulation? So is that a mechanism that's realistic in your view, that simple demand from whom for physical silver would potentially be able to overpower the paper short position?
You know, this is again is a super question. For years and years, okay, I did think that the way that silver was finally going to be set free from the manipulative effects of this giant paper short position would be some type of, it's logical, some type of physical crunch. You lower the price to something a ridiculous level. There's a law of supply and demand. The supply eventually starts to dry up. The demand increases. The lower prices go. So it's natural and ordinary, logical to think that there'd be some type of physical reaction, similar to what we're seeing in palladium now and rhodium, etc. Any industrial commodity, which silver is, can go into a physical shortage. So that is logical. However, I just wrote to subscribers yesterday. I mean, what's really remarkable about this particular situation, I think the physical crunch is still going to come. When I don't know in silver, but it's the physical crunch is not the problem right this minute. Right this minute, the problem is a paper problem for these shorts. It's kind of like the situation, the tables have reversed. While I still think that the physical crunch is coming due to the many years that silver's been depressed in price, there's going to be a catch up and an effect down the road, just like is going on in palladium now. But in more immediate future, it looks like, and it's something I never really expected, the paper shorts, okay, look to be in real problem. And right now, I guess, it's kind of poetic justice in a sense that since the paper market these paper short sales is what has depressed the price for so many years and decades and on the COMEX, it's almost fitting that it looks at this point to me to be a paper problem. I think we're going to have a physical problem down the road. I don't think the physical problem is here right now. It can come real quick if investors come rushing into silver. That you can get an immediate physical shortage, but we're not seeing that. What we're seeing is prices go up, and these shorts, paper shorts, are basically hemorrhaging money in terms of open losses. They're unrealized. They didn't close them out yet. So right now, I think it's much more of a paper problem than a physical problem, with the physical problem still to come. it's kind of ironic, but it's how are these big shorts, have to meet margin calls. If it goes against them, the price has gone against them, and the big thing that's gone against them is gold. It's not silver yet. I mean, there's going to be a problem for them real soon, I think, in silver, but right up until now, it's been mostly a gold problem. I assume, and maybe this is my mistake, anybody who's stupid enough to be heavily short gold as the price has been rising, they're likely the same people who are short silver. It's the same kind of mindset. So I'm thinking it's not guaranteed that the 7 or 8 big shorts in gold are the same exactly as the 7 or 8 big shorts in silver. But I think there's an overlap there. So right now, their problem, to answer the question, is not a physical problem. The longs don't want physical. The longs are paper longs. They're not demanding delivery yet. I mean, they could in the future. But up until now, the paper longs, people who own the futures contracts, are not demanding delivery. They're content to hold the futures contracts and see if the price goes up. That's creating a paper problem or a money problem for the paper shorts. They got to meet these margin calls, and there's a limit. I don't know what the limit is. How much pain the shorts can take on these losses. We're in uncharted ground. But there is a limit. It's not infinity. I mean, they're not going to. This is how people lose their jobs. I mean, if you're the chief financial officer of one of these banks that are short, and you see these losses mounting, and you don't do anything about it, then your job is going to be in jeopardy real quick. And this has all happened now since the last time we met, or the talk, December 16th. It's not that long. There's weekends in there. There's holidays. There's not that many work days, maybe 20, 25 work days since the last time we spoke. And this is all new to the big shorts. The run-up in prices in gold, particularly to the end of the year and continuing into the new year, has put pressure on these financial pressure on these banks and firms that are short the futures, and that's the problem right now. It's a paper problem. It's a money problem. It'll be probably a physical problem, I'm sure, of that down the road, but right now it's a paper problem.
Interesting. Jackie Bridges follows up with a related question. Ted, do you think J.P. Morgan is planning on letting silver go to the moon one day, or will it be more a black swan event that triggers this? And how high do you think silver can go one day if it's freely traded? Also, we appreciate the long fight you've been through trying to get the manipulations to stop and be freely traded.
Well, thank you first for that. Look, I think it's it's one and the same. I don't know if you're going to be able to distinguish. The setup is there. J.P. Morgan is positioned, has already made, as I said, they're up like $9 billion, already on their physical gold, and this thing may just be getting warmed up, according to many people. So it's like they're ideally positioned. They can't help but make money. I think they're going to make a lot more on the silver when that goes, than they will on gold. But I mean, they're already ahead $9 billion on gold. So it's like it's not chump change. As far as a black swan, sure. I mean, they're not mutually exclusive. It's like there's going to be a trigger event, or there's going to be something, whether it's the real reason or not, that's going to fit the bill as a trigger for what sets this thing off. If we really take off to the upside, it's legitimate to try and figure out what the black swan might be. It might be this coronavirus. It could be anything, The setup is there. And it's really more a question, to my mind, that these 7, 8 big shorts, leaving J.P. Morgan out for obvious reasons, they're trapped in a sense. Now maybe they'll succeed, as I say all the time, and manage to knock the price down substantially, scare all the longs who are holding into selling and allowing these big shorts to buy back their short positions as everybody else dumps the contracts. But I've been waiting for this now for almost 9 months. They haven't done it yet. The longs don't seem to be running, and that's what's so unusual. That's what we talked about last time. That's continued. So the setup is there. It's like years and years ago. It's like a friend described like that silver's like this giant, swimming pool filled with gasoline, and there's this guy, walking around the edge, a little tipsy or whatever, lighting cigarettes and flicking his matches to the wind, not knowing what can happen, and you just get a spark, which will be that black swan event, a spark that gets into that, hits that gasoline, and that's what's going to happen to the price. Everything's going to go up. It's when what match is going to do it, what cigarette butt is going to do it, I don't know. I thought we'd had plenty long before now, but better late than never. The setup is still there, and in many ways, this is the most serious setup we've had because this mismatch on the short side, it's held by so few people and the so few entities, and the quantities are so enormous that if they ever go to rush to buy back these short positions, it's the gasoline in the swimming pool analogy. There's no other good analogy.
So walking down that road, then White Man asked this question: all these prepper type channels and stacking channels talking about buying metals, but no one ever discusses where and how to sell your metals either before or after an economic crisis, and selling during a crisis. What, are you going to trade your 1 ounce bar of gold for a dozen eggs at the local farmer's market? So obviously the last part was facetious, but still, right. What are strategies that people who've been seriously accumulating physical precious metal, what signals should they keep their eyes open for that it may be a good time to lighten up, and what are some strategies that people can consider for how they would actually accomplish that?
Well, to be honest, I don't give that as much thought perhaps as I should, because it's been so long in coming and it hasn't come yet. So I'm just waiting for it. Let's get into that. I get a feeling that that whenever people decide to sell, including myself, we're probably going to sell too soon anyway. So. In any event, you go into it for certain reasons. If you're looking for as an insurance policy against assets, other assets, as long as the insurance policy is working, I guess you would leave it on. If it gets to the point where you had a specific financial goal in mind, a certain amount of money that you were looking to make, pay off a child's education, pay off the homestead, set yourself up for retirement, whatever. When that financial goal is realized by the price going as high as you had originally expected, it certainly wouldn't hurt to realize those financial objectives or whatever. As far as, and we know probably silver in particular is gonna vastly overshoot whatever price it eventually comes back and settles down to. So I guess there's nothing wrong with trying to pick a top with a portion of, you don't have to pick 100%. Good thing about, unless you only got one coin, then you got to pick a number and you sell it at. If you have, many ounces, several ounces, hundreds of ounces, thousands of ounces, whatever it is, The good thing about it is, you don't have to make a 100% decision. I'm going to sell it all here, whatever. It's chances are it may have been accumulated piecemeal over time. Probably should be liquidated the same way. I don't necessarily think that just because we go to a 100 or 200 or whatever number in silver that everything is going to be keep pace cost-wise, whether it's food or energy or shelter. So I think there'll be a big advantage in you'll be able to cash in at a high price and utilize the money to other things. So it's an individual decision, but it's a problem. I admit it's not something that that it should be disregarded or not thought about at all. But at the same time, let's get the problem first, okay, and then we'll decide what to do with it. Let's get to those sky high prices that seem out of reach right this moment. If they are reached, then you sit down and you rely on your common sense and you do what you think is right at the time.
We have a question here from 49Fine who says, "Hi Ted, actually a gold question here. What is the reason that the U.S. government states the, quote, official gold price of $42? And is this a, quote, standard price in other central banks and governments, other central-based governments? Does anyone really pay that?"
No, in fact, I didn't even. It catches me a little bit off guard. I don't know what the official price, purpose, what is or what it serves. Nobody pays attention to it. It doesn't affect any transaction. The beautiful thing about gold and silver and other assets is that there is a highly visible price that you can access at any time. It's you can't escape it. It's like it's on TV and the internet constantly. The price. So I would pay absolutely less than zero attention to whatever the U.S. government or any other government assigns as a price on gold, because nobody transacts at that price.
This last question has to do with the nature of the underpinnings for gold versus silver prices and the economic environment we find ourselves in. Mark Schneider asks, if we go into a recession, will silver price suffer? People have talked about silver being an industrial commodity, perhaps more than gold as a monetary metal. But what's your view, Ted, if we fall into a global economic recession, will that be another factor pushing down on silver?
It may be used as an excuse, as a cover story, but not to beat a dead horse here. What determines the price is the paper positioning on the COMEX. So if the big shorts are able to succeed and trick the other side, snooker the other side into selling, which they haven't done up through now, which is highly unusual. We're not going lower in price. We're going higher. A meteor giant meteor could strike the earth. That doesn't make a difference. It's what's happening on the COMEX and what's happening with these 7 or 8 big shorts. That's going to determine the price, if they're successful or not. I don't think they're going to be successful. I mean, I'm certainly rooting that they're not going to be successful. And we could go through all the arguments of what a recession, a true recession, and a long-lasting economic downturn would mean, okay, in terms of silver. But the one thing that you got to keep in mind is that silver, most of the silver that we get, the vast majority of new silver that's produced, comes as a byproduct from other metal production, copper, zinc, lead, gold. If there is an economic downturn, the demand for copper and lead and zinc is going to go in the toilet as well, and eventually it's going to affect the production of those metals, and with it, will be a sharp reduction in the mining of silver. So it's almost, it doesn't make a difference whether we're in good times, bad times. The amount of silver that comes out of the ground is really not that important to price. What's really important is the people that make the price. And this is on the COMEX. Up until now, it's been these 7 big shorts have made the price. There's real serious concern now that they may not be able to continue to make the price as they have in the past. And I got to say, I mean, compared to that, nothing else matters.
Ted, you've been generous with your time, and we wanted to thank you for joining us. Before I let you go, though, can you stick around for one bonus question for our Patreon supporters?
Sure.
Oh, great. And folks, if you're not yet a supporter on Patreon, remember that we can only be here because of the support that we receive by our independent viewers. Less than 0.5% of our subscribers are currently supporting our channel. It's been a big increase in the last month since we put out an appeal. That's awesome, and we need to increase that up to 1% because we are subject entirely now to the whims of Google and YouTube when even a video that we have scheduled for tomorrow night about a cash ban coming to Australia has already been flagged as under review and not suitable for monetization. That can happen at any time, and we've had other independent journalists that have been deplatformed. So that can happen, and if that does, we wouldn't be able to continue to spread this mission and get this word out to people who haven't heard it yet. So join this mission and step up and be part of it, because it's us together that are unstoppable, by going to patreon.com/reluctantpreppers or paypal.me/reluctantpreppers and becoming part of our support team. So, Ted, thanks for joining us here on this public interview with Finance and Liberty and Reluctant Preppers. Always appreciate your presence here with us, and just thanks so much for joining.
Thank you, Dunny. It's been a pleasure.
They say the stock market crashed today.
Yeah, I heard that.
Sounds like people's retirement accounts and savings accounts are going to get bailed into the banks.
Yeah.
Looks like pension plans and Social Security are going to get suspended too.
I know.
Sure, I'm glad we decided to put our money into gold and silver instead.
Me too.
Get your first ounce of silver at spot price and free shipping on any order over $99 at sdbullion.com/rp. Reluctant Preppers provides educational awareness and commentary only. Opinions expressed do not constitute personalized financial advice. Viewers are encouraged to do their own research and seek qualified personal financial consultation before making investment decisions.